Look up at any major financial district, and you will see the sheer volume of numbers moving across digital tickers. Every second, billions of dollars are shifting hands across a massive, highly intricate global network. Entire university departments are dedicated to studying its movements. Thousands of analysts build their careers trying to decode it, and financial news networks broadcasts its every twitch 24 hours a day. But if we pause the news feeds and mute the trading floor shouting, a question remains. Beneath all the screens and the relentless flow of data, how does this system actually work? To answer that, we have to strip away the digital complexity of modern finance and look at a very practical problem from the 1600s. During the 17th century, the Dutch East India Company operated a massive global shipping network, sending hundreds of heavy wooden vessels across the oceans. These ships were moving highly valuable physical commodities from one continent to another, bringing back gold, silk, porcelain, and heavy sacks of spices. But running a global trade network was difficult. Preparing a single ship, hiring a crew, and surviving a dangerous months-long sea voyage required huge amounts of capital, often far more than one person could provide. So the company offered a solution. They asked ordinary citizens to help finance the voyages. In exchange for putting up their own money, these individuals would receive a fractional share of whatever profits the ship brought back. As these voyages succeeded, people naturally wanted to buy and sell these ownership interests. European coffee houses and major port cities evolved into physical meeting places where buyers and sellers could negotiate the value of those shares. This model of pooling capital from hundreds of individuals proved that shared risk and reward could fund enterprises far beyond the reach of a single person's wealth. Let's bring that 17th century model into the present day. Imagine a modern, highly popular coffee company. They have a successful business model and want to rapidly build new stores, but they need a large injection of cash to do it. To raise that money, the company enters the public market. This process is called an initial public offering, or IPO. It is the exact moment a private company offers its ownership to the general public for the very first time. When you participate in this market, you are buying a share. And as historical stock certificates like this one prove, a share is exactly what it sounds like. You are purchasing legal ownership of a tiny fraction of that specific business. It is a mutual exchange. The coffee company takes your invested cash to build their new stores and develop new products, and in return, you secure a stake in the company's future. An IPO takes a private ambition, like building a great coffee brand, and converts it into a publicly traded commodity that anyone can buy into. This chart shows a success scenario. As sales and profits grow, eager investors outnumber the limited supply of shares, directly forcing the stock price up. Conversely, if the company loses money, confidence vanishes. When panicked sellers outnumber buyers, the stock price is forced down. Whether the commodity is peppercorns or software, this specific balance between available shares and buyer demand is what dictates the market value. But a company's internal profit margin is rarely the only variable in the equation. The market operates in the real world, which means it is constantly reacting to external forces. At the macro level, businesses are heavily impacted by shifting interest rates, rising costs for raw materials, new trade regulations, and sudden changes in tax policy. At the micro level, investor confidence can be instantly damaged by a sudden change in leadership, a product recall, or a public scandal. All of these unpredictable, interconnected variables collide at once. That collision creates the dense, chaotic daily fluctuations you see tracked across global trading floors. There is one final, highly volatile force driving the market, and it doesn't fit neatly onto a spreadsheet: mass human emotion. Widespread optimism can push a stock's price artificially high, far beyond what the company's actual underlying revenue justifies. Conversely, sudden panic can cause a massive sell-off, tanking the share price of a business that is otherwise perfectly healthy. This continuous psychological battle between fear and confidence is why seasoned financial experts tend to ignore the daily noise. Instead of trying to predict what the market will do tomorrow, they focus on long-term strategy and the underlying health of the businesses they invest in. For much of its history, the market was inaccessible to the average person, requiring significant capital and proximity to specialized brokers in these institutional buildings. Today, the internet and digital platforms have removed many of those barriers. Everyday retail investors can now research, track, and buy shares in publicly traded companies directly from a smartphone. But accessibility does not eliminate risk. The market is not a guaranteed shortcut to sudden wealth, and participating without a clear understanding of your own financial capacity often leads to heavy losses. At its core, investing is simply a tool. It is an opportunity to put your capital behind human ambition, with the hope that as a business grows, the value of your stake grows with it. Before you ever risk a dollar in the market, the very first mandatory investment you must make is in your own education.